Dear friends, this is C.S. Sujata. In today's Crack the Code series, we are going to understand about mining industry and the applicable GST relating to mining industry and what are the intricate issues that are involved in mining industry with respect to GST. First and foremost, let us understand how the industry operates, and second, we will understand how the industry has been evolved over the period of say 35 years and the legal issues that were handled by this department, by this industry as such, in terms of taxation and in terms of royalty and other things. And lastly, the GST part of it. What are the applicable GST and how it can be paid? What are the modus operandi in terms of payment of GST with respect to mining and leasing? So if you look at the industry, the business model is that if somebody wants to get into the mining and mineral industry, he has to take a license from the authority. The license is basically for right, it's basically a right to acquire and extract the minerals, excavation of mineral. And once when you want to excavate a mineral from a particular surface or particular land, the agreement that you get into with the department is mineral right. Unless and until you are given a permission to enter into the land, that is for the surface of the land, you will not be able to dig the land and extract the minerals out of it. So basically the right is a composite right for entering into the land, that is permitting, the government is permitting you to enter into the land, giving you the right to enter into the land and do the mining activity also. So when you do the mining, when you enter into a license with the department, the rights that you are getting is mineral right and mining right. So who's the controlling authority for getting these kind of licenses? Is that predominantly it is government, but there are private players also who give their land on lease for extraction of minerals. Government is the concerned department, which is a state government department. It is minerals and geological department is the controlling authority for permitting you to excavate the minerals from that land. Who can lease the land? Anybody can lease the land as long as they fit within the bidding parameters. Basically, the majority of the leasing happens through government because it's being a heavy investment in terms of excavation and selling of mineral, and it is a long drawn process. There are very few high net worth individual are permitted or get into the business of extraction of minerals. So the Coal India or those kind of Steel Authority of India, those kind of government entities are generally involved in mining and mineral industry. So if you say minerals, what are the kinds of minerals? How will we know on what type of land, which kind of minerals can be extracted? This is basically done with the feasibility study. The government gives the land and there is a feasibility study which is done by another department and submits the survey, submits a report stating that this is what the availability and quality of minerals available in that expected or potential for that land area, and what would be the cost involved, what is the market potential. There would be a survey and report submitted by the government which is available for public domain. So the business owner who are interested in getting into this business can approach the government, get the report as per his funds availability. He can go approach the department and then get the land leased in his firm's name. So the land lease is given for 3 to 5 years, and after renewal it goes for up to 10 years, and it goes on renewal process. When what type of minerals you get, if you ask me, there are two types of minerals. One is a major mineral, other one is a minor mineral. The act specifies that the minor minerals are the ones like limestone, clay, jelly, any mineral for that matter that you use for construction of a building is called as a minor mineral. Other than minor mineral or major minerals. The precious stones, say gold or thorium or magnesium or any kind of material minerals, if you see, those will be treated as major mineral. So how does the government allot leasing rights? It is through bidding process. So the tender will be called for. Those who qualify with the tender terms and conditions, they are allotted the mining lease, and the cost is very extensive. The land area ranges between anywhere between about 100 hectares. It's all measured in hectares, and the investments also accordingly varies. So in the initial years of lease period, there will not be any yield from that land. So what will happen? The mining activity may not happen. So, or it may not yield any required minerals that were expected. So in the first year, Mines and Minerals Development and Regulatory Authority Act is the parent act, which governs how much should be the royalty and what are the various parameters which the miners will have to follow as spelled out in the act. This is a central act, but since the land being a state matter, the mineral excavation is a state matter, there is a corresponding rules are specified in the respective of cost involved. When a miner wants to pay to the government, what are the charges involved? Let us understand that. One is that mine tender document purchase fee. This is nothing but a e-auction fee payable to the Directorate of Mines and Technology. And other one is a royalty, which is a very important factor. It is paid either as a fixed sum depending on the mineral, or it is paid on ad valorem basis. Ad valorem basis is based on the selling price. Since this is more of unregulated industry, in the sense the mining industry and mineral industry is not that regulated. It is not regulated in the sense, since it is operated by selected set of people, the finding out the market price, unlike other commodities, is bit difficult. So what happened, there is a board called Indian Bureau of Mines, which does the survey of what is the ongoing price for that month, and it publishes the market price for that particular mineral at particular month on a specified date. So the royalty is based on the data published by the IBM. So next is that dead rent. Dead rent is the price that is paid to the government. Minimum rent, you can call it, because in the initial years the land may not yield anything. In such cases, either the land miner has to pay either the minimum dead rent, when as and when it starts producing, then the dead rent or the royalty, whichever is higher, will be paid to the department. Apart from that, there is something called as contribution to DMF, which is District Mineral Foundation. This foundation is an NGO which works for the interest and benefit of workers who are working in that mining area. Since these are all chemicals and minerals, the laborers who are working in that mining area and surrounded places or villages or forest area are all exposed to certain specified diseases. It is a government duty to take care of such people who are surrounded in that mining area. Hence, there is some kind of contribution as a percentage of royalties collected from each miners and then deposited by the department to the respective foundation. Then there is next called contribution to NMET, National Mineral Exploration Trust. This trust works on the discovery of minerals, exploration of minerals, invention of minerals, and how using the latest technology, the output of mineral can be improved, the quality of minerals can be enhanced, and how should be the soil, and what all the feasibility studies can be done, and how many years the land should be put to rest. So these kind of mining related research this organization does. This is also another non-profit organization. So for the future development in this sector, for the future growth of this sector, these funds are collected from the miners and deposited into that fund. Later is the auction premium. It is paid by the winning bidder. Whoever bids the higher amount, this money is paid to the government. And auction price is the bidding price the miner is willing to pay for mining the minerals. So some base price will be set. Over and above that, whoever quotes will win the bid. It's just like any other normal tender and bidding process of the government. Now let us understand the legal side of the mining industry. If I have to take you through the mining industry, it is governed by MMDR Act 1957. This act is majorly enacted for the purpose of development and regulation of minerals. Prior to 1950, that is prior to the constitution, the act was called as MMRD Act, that is Mines and Minerals Regulatory and Development Act. Then the miners said there is no development is happening. How can you start regulating without even development of doing some research and feasibility study? Without helping us, how can you start regulating us? So that's the reason why after 1950, the act got changed to MMDR, Development and Regulatory Act, Mines and Mineral Development and Regulatory Act. So this is a central act, but as I mentioned earlier, there are two types of minerals, major mineral and minor mineral. So for the minor minerals are administered and controlled by the state government, that is state act, which is list 2 of schedule 7 of the constitution, whereas the MMDR act is a central act. The rules are given, the powers to enact rules are given to the state as per section 9 of the MMDR act. So basically the administration and control of mining is done by the state government. So each state will have its own mining rules, which specifies how much of rent to be collected, how much of royalty to be paid to the respective states depending on the minerals. So it varies from state to state. Another question is that can one state person, miner in one state, can he go to the another state and extract minerals? Yes, that is also very much permitted. So next is that let us understand constitutional provisions relating to mining. The Mining Act, it may be a central act, and the tax and administration of it has been given to the state as per the list 2. However, the regulations and mines and mineral are subject to the provisions of list 1, which has got the ultimate control over the administration and tax collection rests with the central government. So list 1, the act is under list 1, the act is enacted by the parliament, whereas the administration and tax collection powers are given to the state. However, the control of administration and tax collections are overseen by the central government. So this is the constitutional provision applicable with respect to the mining industry. So next question comes, since the royalty is collected as a percentage, when is the royalty collected? The royalty is collected only upon production, only when the minerals go out of the factory, or only when it is consumed. So if that being the case, as per the constitutional provision, if you read it, Article 366(28), subclass 28, which reads taxation as includes imposition of tax or imposed, whether general or local or special, and the tax shall be construed accordingly. This is the wordings of Article 366(28) with respect to taxation. If that being the case, since this is the tax, royalty has been imposed on extraction and sale of minerals, can it be construed as a tax? This was the question pending before the authorities in the year 1989. Now we are in 2025. The simple question of whether royalty is a tax or not traveled for about 34 years to give a conclusive answer that royalty is a tax or royalty is not a tax by the Supreme Court, Honorable Supreme Court. Now let us understand the journey, how the royalty is a tax or not evolved and traveled over a period of 34 years. So last year, in the month of July, there is a landmark judgment, Mineral Authority Development of India versus Steel Authority of India. We call it as a MADA case, MADA judgment. This is a landmark judgment with respect to whether royalty is a tax or not. It's a 9-bench decision. It was held and concluded in the last year that royalty is not a tax. Royalty is not a tax. It is a consideration paid against the services rendered by the government. It's a contractual obligation. So this was the verdict which was pronounced in the last year. Now let's see, in the year 1957, MMDRA brought regulations through which the miners were to pay tax. So this was introduced in 1957. In the year 1963, the Tamil Nadu government granted a mining lease to India Cements case. So this is also one of the landmark judgment delivered by Honorable Supreme Court. We call it as a India Cements case on royalty. This, when in 1963, when the government, Tamil Nadu government imposed tax on royalty, it imposed cess, the municipality, that panchayat imposed cess on the royalty. So India Cements challenged the cess, arguing that the Tamil Nadu government, that is the state act, lacks competency to impose any cess on the tax which is already levied on the royalty. It means that the panchayat does not have any locus standi to collect cess on the royalty, which is also a tax. So tax on cess is not sustainable and it lacks jurisdiction. The state government does not have any competence, any legislative competence to collect this cess, was the question before the High Court. Then the Supreme Court in the year 1989 held that royalty is a tax and Tamil Nadu government lacks jurisdiction in levying cess on tax. So it is not permitted to levy cess on the royalty. So this was a judgment which was pronounced in the year 1989. Then later came in 2004, the state of West Bengal versus Kesoram Industries. This is a 5-bench team, 5-judge bench. of Honorable Supreme Court, and it found some lacuna in the previous judgment of India Cements. It pronounced that there was a typographical error in the previous judgment, which was held in the year 1989, and royalty, instead of making it as a cess on royalty is a tax, they have mentioned it as royalty is a tax. So that was a typographical error. So that they said it has to be corrected as royalty is not a tax. So this was the position in 2004. Then again, this matter went up to the Supreme Court. In the Supreme Court, in the year 2024, again nine judge bench upheld the five judge bench ruling of Kesoram Industries and held that the royalty is not a tax. So as we stand today, we have to keep in mind that royalty is not a tax. It is only a contractual obligation payment. It's a consideration paid to the government for the services rendered. What is a service? It's a right over the land. What is the right? Mineral right. Is that what? The licensing of mineral land. Is that what the government is providing as a service? So the miners are required to discharge the lease rental license in the form of royalty. So this is the background and legal jurisprudence for mining industry. Now let us get on to the GST, in what way it is going to impact. Before understanding the GST on royalty, we have to see whether government can render any services. Even if it renders, the services rendered by government, will it be called as a supply? Is it subject to GST? Because many of us think that government is in the service of betterment of public general citizens, and this is the duty of the government to protect the citizens of India. It is a sovereign function. So whatever services rendered by government is not subjected to any tax. This is a misconception in any common man's mind. Please bear in mind that as far as GST is concerned, if you look at the definition of business as per subsection 17, subclause 1, the activity or transaction undertaken by central government, state government, local authority, in which they are engaged as public authorities, is also called as a business. So whatever services the government is rendering is called as a service supply only. Next, if you look at section 7.2, notwithstanding, it's the section 7 is the mother section for any supply. We have to find out whether the mining service, leasing of mining land given by the government, state government, does it amount to supply? If you read section 7.2, it starts with a non-obstante clause, which says, notwithstanding anything contained in subsection 1, activities or transactions specified in schedule 3, or such activities or transactions undertaken by the central government, a state government, or a local authority in which they are engaged as public authorities, as may be notified by the government on the recommendations of the council, shall be treated neither as a supply of goods nor as supply of services. It means that unless and until the services rendered by government, it is notified through notification by government under the suggestions of the GST Council, it will not be treated as neither supply of goods nor supply of service. If it is not specified, if any item that is not specified, GST is applicable. This is the meaning of Section 7, subsection 2, subclause B. So, what do we understand from here? The government is rendering business just like any other entity, though it is involved in the public interest. Second, the services rendered by government will be construed as supply unless and until it is specifically excluded in the form of notification as Schedule 3 item. So, if you ask me what is the item till date under this 7(2)(b) is the liquor license, is the one which is not taxable, which is not leviable to GST. Otherwise, all the other services rendered by government, we have to see it. It will fall under supply. Later, we have to see from supply whether it is taxable or it is exempted, who has to pay, whether it is under forward charge or reverse charge, through which notification. All that we need to understand at a subsequent point. So, to conclude, the state government services of licensing of mine is a taxable supply as far as GST is concerned. So we call that license fee is as in the nomenclature as royalty or dead rent. Now let us understand what are the issues in GST. Whether GST is payable on only the royalty or there are other associated contributions. If you look at the exemption, notification number 12/2017, there is no specific exemption for royalty. Whereas if you go to notification number 11/2017, under chapter 9973, HSN 9973, which says leasing or rental services with or without operator, there is entry number 17, which says that the same rate of central tax is applicable on supply of goods, supply of live goods involving transfer of title in goods. So this was the position till 2018. So later, if you look at it, there is an amendment to this entry number 17. So we have to refer to the recent amendment, through which what we derive is that if there is no entry, you do not find any particular entry under that category, then you have to go to residual entry. Under residual entry, there is a tax which is specified for services in notification number 11/2017, dated 28 June 2017, as 18%. So, as we stand today, the royalty is subject to GST at the rate of 18%. Either you can choose 997337, which is under entry 17, under grouping heading 9973, or under residuary clause. Next is that because 997337, licensing services for right to use minerals, including its exploration and evaluation, is specifically mentioned. So ideally, that should be the correct entry for payment of GST on royalty. Next question, is it a forward charge or reverse charge? So we have to refer to notification number 13/2017, entry number 5, which says that services supplied by central government, state government, union territory, or local authority to a business entity will fall under reverse charge. There is no question of arguing that the contribution to fund, trust, or foundation, those are all welfare related activities. It is in the form of contribution. There is no underlying supply, so GST is not applicable. So that argument may not stand before the authorities. The video was useful. Thank you so much for patient listening. Thank you.